If you've ever lost sleep over market volatility, this video could change everything for you. There's one number that can reduce investment anxiety forever. Most have never calculated it. Financial advisors don't typically even talk about it. But once you know it, those scary red days in the market just become another day. I'm sure you've been here before. If you can picture this, you wake up, you take a look at your phone, and your portfolio is down 8%. You think to yourself, should I be doing something different? Should I call my advisor? Should they be making changes? Am I going to be okay? Well, you're panicking over the 8% drop in your portfolio. There's another investor that's going on with their day as if nothing happened. The difference? They know exactly how much they can afford to lose and still achieve their financial goals and dreams. The knot in your stomach, the urge to do something different, it totally makes sense. It's not your fault that you feel these things, but the reality is there's a number that will help us eliminate that fear and reduce the anxiety. Let's talk about why feelings can be a bit misleading. A lot of financial advisors will start an engagement with a client with a quiz, a risk questionnaire. These risk tolerance questionnaires are a bit misleading. You see, I've done them with my clients. I still do. It's good to have on file. But it's not a great North Star for us to determine how we should put together an investment portfolio. The risk questionnaires tend to change from time to time. If I meet with a client during volatile times, they seem to be more risk adverse. They want to take on less risk because it's scary outside. Then when I meet with them during good times, opportunistic times, they think, well, wait a minute, the market's booming. I want to be outside. Put me in the aggressive stuff. Risk tolerance is not really the best metric for us to construct a portfolio, but that the individual investor, the do-it-yourselfer, actually achieves a much lower rate of return over a period of time than the US stock market. And why is that? Is it fees? No, it's not financial advisors and their fees. In fact, studies show that if you do have a financial advisor, you're more likely to make it through those volatile times. The correlation here is actually market behavior, investor behavior. If you see that the market is going down, sometimes investors pull their money out. If you think that the market looks good, others think we should join in. But the problem is getting that right twice and timing the market is a big challenge, even for the greatest portfolio managers. So using our risk tolerance as a gauge of whether we should be in the market or out of the market is actually a pretty bad idea. If we take a look at this graphic from 2000 to 2010, we quite literally see people buying high and selling low. We always heard the phrase buy low, sell high, but it's easier said than done, isn't it? The stock market, as it went down, we see money market reserves going up. That means people are moving their money from the market into cash in their portfolios. But then we note that as the market goes back up, we actually can see money market reserves coming down. So people move their money from their cash into the market thinking, well, the coast is clear. It's safe to play outside. But here's the problem. It's quite literally doing the opposite of what we said. We're moving cash away and missing some of the best times in the market as it returns. We're buying high and we're selling low, the opposite of what we ought to be doing. This is why risk tolerance and the way that you feel about risk is less important. There's another number that we can calculate that will help you during volatile times. This number is called risk capacity. Once you know it, these market drops won't be scary and they'll start being a bit irrelevant. Risk capacity is simple. It's the maximum amount of risk or loss you can take in your portfolio in order for you to still achieve your goals and dreams. I think about the phrase willing and able. We hear that sometimes. Willing is one thing. Able is a totally different thing. I'm able to go to the gym every day. Thank God I have good health. But am I willing to go to the gym every day? Maybe not so much. Willing and able is very similar when we think about risk tolerance and risk capacity. I'm capable of taking on a lot of risk, but I'm not willing to take on a lot of risk. That's valid. That's totally different. We should start with risk capacity, calculate how much portfolio risk you can afford to lose, capable, and then couple it with how much risk you're willing to lose or take on, because that aligns with your experience that you're getting. Qualitative and quantitative. Risk capacity is more about the numbers and math. We don't really care about your feelings when we're talking about risk capacity, but risk tolerance is still valid. It's just secondary to risk capacity. If we know that your portfolio can take on 40% risk, where you could lose 40% in your portfolio, Then risk tolerance might say, well, I'm not willing to lose 40%. I'm only willing to be down 20%. Well, that's very different. Okay. So the point of this is if we know that risk capacity says you can lose up to 40% of your portfolio, and risk tolerance says that you're only willing to lose up to 20% of your portfolio, then there's no reason we should be really worried about a 6% loss in the market, no matter which metric you're using. But let's talk about the factors that go into considering your risk capacity. Number one, the first factor is time horizon. The longer we are away from touching the money, the more risk we can take on, because over time, markets are healed by time. If you need the money in 2 years, well, then we shouldn't take on so much risk because there's not enough time for us to recover. So your risk capacity is low. The second factor in considering risk capacity is your income stability. When we're calculating our retirement income goals, and we say maybe we need $8,000 a month to come in, let's look at how much we have from guaranteed income sources. Do we have Social Security? Do we have a pension? If yes is the answer, well, then our risk capacity could be a little bit higher because we're really relying on our portfolio for less of our income. Factor number 3 is account balances. Now, this one seems fairly obvious. If I have more money, I could take on more risk. If I have less money, then I can take on less risk. But you'll be shocked at how many clients come to the gates of retirement squeaking by with just enough, yet they're willing to take on a ton of risk because they think that they need to be more aggressive in order for the plan to work. That may not always be the case. We should maybe take a look and find a balance between risk tolerance and risk capacity while achieving your goals. And goal flexibility, that's the fourth factor that may be considered in calculating your risk capacity. If we know that we want to retire at 62 and that's it, we've got no other options, we're done, we are out at 62, well, then your risk capacity should be a little bit lower because you don't have much flexibility in your goals there. If you enjoy your work and maybe your identity is pretty significantly attached to the work that you do and you're okay to retire at 62, 65, 67, then your risk capacity will be a bit higher because your goal flexibility is higher. Let's look at a real life case study. This is Bob and Mary. So I'm going to show you exactly how this works in this example. They're planning to retire at 62. They've saved $2.2 million plus $30,000 in their emergency fund. Social Security between the two of them combined will be about $4,500 a month. And their income goal is about $8,000 a month before taxes. If their income goal is $8,000 minus their $4,500 from Social Security, then that gives us a shortfall of about $3,500 a month. That's their income gap. Figure this is about $42,000 a year after taxes. So we found the income gap, but now let's talk about time horizon. We've given them a planning horizon for 90. Age 90 is when we think that this will be the end of our plan. Now here's the magic. Using present value calculations, we can figure out exactly how much they need at retirement. The results may surprise you, but with the 60-40 portfolio, they need about $910,000. With the 70-30 portfolio, they need about $860,000. And with an 80-20 portfolio, they actually only need about $800,000. You see, the more risk that they're willing to take on, the more likely they're able to achieve their goals. But the interesting thing is, even with $2.2 million saved, they really can be as conservative as they'd like. See, now this is where risk tolerance comes into play. Risk capacity says you can afford to take on all of the risk that you would like. Risk tolerance says, how much risk would you like to take on, though? So as you can see on the screen, their risk capacity is actually quite high. They can afford to lose more than half of their portfolio, still achieve their goals, and leave behind $2.5 million. Now, why do I mention this? Do I think that everyone should take on 100% equities and be extremely aggressive? Absolutely not. I think risk tolerance is very important, but we need to remember that when the market is down 6% or 8%, but your portfolio can afford to lose 60%, we shouldn't be too worried. It's okay. It's just another day in the market. This is why risk tolerance without risk capacity is meaningless. You can't accurately access your comfort of risk until you know how much you can actually afford to lose. Bob and Mary's risk capacity gives them choices that they didn't once have. They could stay conservative for peace of mind, or they can take on more risk knowing that they have enough room to take a hit. They've got enough cushion. So here's the homework that you need to do in order for you to calculate your risk capacity. Step one is to figure out your timeline for each goal. If we're talking about a timeline that is short for a down payment, well, then we can kind of assume that we've got lower risk capacity. But if we're talking about 20, 30 years from now, depending on how much money we have, we may have a higher risk capacity. The first factor going into this is going to be time. The second step will be determining how much money do we actually need on a monthly basis. Subtract your guaranteed income sources like Social Security and your pension. The third would be using a calculator. There's plenty of DIY online calculators, although we'd love to do this type of work for you. But if you did go online, start playing with the numbers to say, if I've got $2 million and I need $3,500 a month and I need it to last 30 years, is that going to be sustainable? What's the account balance after I've done that? Assuming an interest rate of maybe 4, 6, 8%, whatever you'd like to use. And then the final step is guess and check. If you have $2 million today and the plan works, what would happen if you had $800,000? Would the plan still work? The other thing to consider is if you wanted to leave money behind and you had a number in your head of how much you wanted to leave behind, use that number as well to determine, does the plan still work? The plan being, is it just income or is it also legacy? Once you know that number, it will help you determine how much risk you're willing to take on once we know how much risk we're capable of taking on. So next time the market drops, you need to ask yourself, how much can I afford to lose? Should I really be scared or worried while everyone else at work is talking about what's going on in the market? The peace of mind is found in your risk capacity. So I challenge you to work with your advisor, reach out to us, or figure it out yourself. But at least once you know your risk capacity, then you can start having conversations around risk tolerance. Markets will always be volatile. That's never going to change. But your emotional reaction to volatility, that can change today. If you'd like to download a retirement checklist in the link below, you'll learn a little bit about the things you should consider before going into retirement. Thank you for taking the time, and reach out if you have any questions where we can calculate your risk capacity and put together a portfolio that aligns perfectly.